I think the tide is turning. I think we've been calling this thing right all along. And I've got a story for you too this week. Hey, I'm Aaron, with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. So let's get into it. So before I begin with the presentation, I just want to tell you a quick story. So a couple years ago, when the whole market was looking for jet fuel to be the savior. That was jet fuel was gonna take off, if you will, pardon the pun, and that was gonna lift the entire market out of the doldrums that it had been in. Of course, this was after COVID, and we were, a lot of things were in flux, especially on the demand side of the equation, especially in the West, where things were shut down for a while. But I remember that everyone thought, yeah, the jet fuel, that's what's gonna cause this market to bounce back. And so that's kind of the underlying base case of what's going on. But we were on one of those conference calls we used to have every week where we get all the traders on from all over the world, from of course us in the Houston office, and we'd have the guys in London, we've had the guys in Asia, all be on the phone at the same time or the conference call at the same time. And I remember the guys in our Asian office saying, well, the jet fuel curve just went into contango. And I kind of, you know, literally fell out of my seat on the floor, and everyone's kind of turning around to look at me to see what's going on. They're like, what's wrong with you? What's wrong with you? And I said, did you hear what he just said? He said the market's in contango. And they're like, yeah. And I said, that's it. This is where the whole thing turns. And so after the call, we started chatting there on the desk. And I'm saying, look, if this market that's supposed to be able to pull the whole world out of this, bog and mire that it's been in over the past few years is suddenly in contango, how does that help anything? Right? And of course, if you recall, contango is when the front month is cheaper than the forward months, and it usually implies that the front month or the spot market's a little bit soft, and the market's hoping things will be better in the future. But in reality, the cheapest part of the market is sort of what you've got right now in the front of the curve. And they're all looking at me like, yeah, that is interesting. Yeah. And I think that was the shift in sentiment, because it obviously wasn't just us that saw that. It's a curve that the whole market watches, right? And so everyone could see that happening, and sort of like a collective light bulb going off over that time period where the market had been relatively bullish. And then all of a sudden, after that event, after that contango was noticed, or priced into the market, maybe is a better way of saying it, that's when the whole thing started to sort of unravel that year, and the whole market started to sell off. And I think we've had a similar event happen here in the last week. Now, unfortunately, I was a little bit under the weather, had some sort of seasonal cold or something like that. So if my voice still seems weird or whatever, please forgive me. But that's why I didn't put out a recording last week, because I definitely could not talk. But what was interesting is EOG put out some headlines, and they were recorded by, or I saw them through Bloomberg, and the way they were presented through Bloomberg was to say basically that this year the demand is not great. Let's start looking past this year, and let's look to 2026. Things will be better in 2026. Now, in my mind, EOG is the very best independent oil and gas company in America. And if they can't find a way to grow, if they're worried about demand now, and they're telling their investors, hey, let's start looking at 2026, that's not a bullish thing to have happen, right? So again, in my mind, that's sort of the change in sentiment, the same sort of thing as a couple of years ago, jet fuel suddenly falling into contango. Like, this thing just isn't sustainable when you have companies like EOG, who's the very best at what they do, saying, yeah, maybe we should write off the balance of this year and start to look at next year. Now, again, as I've been saying, I go into much more detail about this, and if you go to my website and you hit the add me to your distribution list, and put in your information, I'll gladly add you, put you on a free trial of the bigger version of this presentation that I put out along with some notes and stuff. And you'll get to see those exact quotes that EOG was talking about, and you'll see maybe in more detail in both the commentary and in the visuals what I was talking about. But um, I think what we're seeing is that shift in sentiment coming this year. That's really gonna sort of pitch us over into a more bearish market. Now, there's been a lot of other things going on, and I'll show you here. We'll start the chart pack here in a second. But I just also want to inform you or let you know that we're seeing in like the commitment of traders data, we're seeing, things that would back up this change in sentiment, right? The longs divided by shorts, or the long to short ratio, is probably at the lowest it's ever been, or at least a very low number, which is good and bad, right? Because then you don't have the long positions to stop out like we did before. Maybe let's go ahead and start the presentation, and you'll see what I'm talking about here. So just give me 1 second. There we go. All right, so if you look back here, there we go, get the pointer out now. So this is last week's price action, and this is a continuation crude chart. And so you can see that we've broken this support line here, which is not ideal. We're also below, these are Bollinger Bands I have running here. Again, not my favorite thing, but I think it's a pretty good indicator for right now of what's going on, especially since we broke from the bottom here and above the top back here. So relatively recently, we've seen some activity on those Bollinger Bands. So anyway, we're below this middle line in here in the Bollinger Band. We broke the support number. We've got this horizontal support line coming in just above $62. If we break that, then what? Right? It's not looking very good. Then you go back to sort of this $55 area that we tested briefly in April. We sort of tested it again in the month of May. But again, things were looking really heavy at that time. We were worried about tariffs. We were worried about all sorts of stuff going on. So we did have another sort of descending trend line going on now, but you can see we're sort of past that. I should probably go back and delete this line now. It's not too helpful to us at the moment. So the point is, if we break this horizontal support line, there's not too much more to stop us from retesting 55, right? And this Bollinger Band line will move as the market, if the market did drop, it would sort of move to start to get out of the way. It's just a matter of how fast the market drops if you catch up with that bottom Bollinger Band or not. But the point is, I'm starting to get fairly bearish about this thing. So in the summertime, in the oil markets, especially in the US, you want to be somewhat optimistic. That's the time when demand can really shine. You don't really get in the way of that too much and let it play out and see what it does. But now we're coming up, on the end of driving season, as it were, and we're not too far away from that. We do have planting season to go into. And so the distillate market, I would expect, to sort of step up and become the preeminent refined product market. But we're running out of time for driving season to really support this thing. And we're getting some really strong refinery demand numbers, at least on the domestic front. So I've circled here. Hopefully you can see that. Pad 2 actually set new 5-year highs for refinery runs or crude inputs into refiners. If you want to look at it that way, it's another way of describing the same thing. So really strong in Pad 2, which again is the upper Midwest or Midwest region. In the Pad 3 in Gulf Coast, we've got very strong numbers as well. On the East Coast, which is Pad 1, we came up with very big numbers again this week at top of the 5-year range. And West Coast is still chugging along pretty good, also roughly at the top of the 5-year range. Now, this is probably going to come to an end here pretty quickly. We've got Norco already saying that they've shut down units. They had a planned turnaround scheduled for, and that's a New Orleans market refinery run by Shell. They've pulled forward plans to go to a planned maintenance 2 weeks early. So they started shutting units down on Friday. We also had news of an issue at Bayway. It looks like it was solved pretty quickly, but we could see maybe some impact in the crude runs number next week, maybe on that Bayway issue going on. They seem to solve it pretty quick, so maybe we don't see much at all. But pad 3 is where I would expect to see maybe the bulk of the decline if we do see one next week. Again, that just started on Friday, so next week's numbers might be a little too soon to look for that. We might be talking 2 weeks out from the time this publication goes out anyway. So that's kind of quickly coming to an end. But what's frustrating is you would think if we're running our refinery system so hard, we should be building inventory, right? Or either that or demand's fantastic. Well, not really. So in terms of transportation fuel, so what here I'm referring to transportation fuel as gasoline, jet fuel, diesel fuel, and even fuel oil, which is a relatively small component, but what the heck, throw that in there too. So those inventories are at the bottom of the 5-year range, even with refinery runs looking really strong. So if you want to look at it in terms of like a year-on-year comp, the last 4 weeks of refining runs have been just north of 17 million barrels per day, which is probably pretty close to a maximum of what we can do. In my mind, 17.2 is sort of the maximum sustained level. Of course, you can get little blips up higher and lower, but in terms of maybe like a 4-week average max, it's probably 17.2, something like that. But and so we've been at a very high rate, again, about 400,000 barrels per day up year on year on a 4-week average sort of thing on the crude throughput or crude into refineries. And then on the demand side of things, if you take out the really strong January and February, because again, that was more heating related, and we're looking primarily at transportation fuels for the moment. So let's take that out. Let's look just at the March through sort of current, or the March through end of July demand numbers. Were up about 0.4% on those combination of demand fuels, the same combination I mentioned a second ago. That's not too shabby. It's not terrible. It's up, right? It's not down year on year. The exports are down quite a bit, again, over that same time period, looking sort of March through current or March through end of July. Those are down, about 4.5%, something like that. So again, you would think that we would be able to get inventories to start building maybe a little bit, and that would be, that'd be a good thing to happen. You can see sort of seasonally inventories do draw from October, November timeframe, because that's when you've got refinery maintenance going on. On the demand side of things, you see these little spikes here. You've got, again, harvest season demand going on. You've got the end of driving season, people may be taking one last trip for the season sort of thing. And then you got the holiday demand, which you can see little spikes coming in for that as well. So directionally, once you get past the harvest demand, you do have a little bit of holiday demand, but you can see if you take that out, kind of just grinding lower towards the end of the year is fairly typical. It doesn't have to be as pronounced as it was last year, but that's sort of the typical thing one would expect. So if we change gears a little bit and say, well, okay, we've got really strong crude runs in the US, and actually crude inventories have gone up since January. We put in sort of a low water mark. Sorry, not January, in June. At the end of June, we put in a low water mark for crude inventories, and we have sort of built those up a little bit, but it's come at the cost of exports. Now, that's really interesting to me. Again, keep in mind that EOG, the sort of preeminent independent oil and gas company, is saying demand's not fantastic in 2025. Let's start looking towards 2026 when the S&Ds, the supply and demand balance, the oil balance, should be looking a lot better. And again, that's should be, right? Because it's all based on predictions and forecasts and that sort of thing, which is fair enough, but it's a little bit unusual, again, when you have someone like that coming out and saying, yeah, let's kind of forget talking about this year, and you look at your watch and it's only August, right? So what's happening? What demand are they looking at? We just saw transportation fuel demand in the US is not bad. It's up 0.4% year on year. Again, if you isolate that time period between sort of March and current, where you're getting actual transportation demand and you're not messing too much with heating demand in there on the distillate side of things. So what are they looking at? Well, one thing they could be looking at is the macro stage, the global stage for crude oil. So of course, along the past couple months, as we've reported here, and you've probably seen in the news and elsewhere, OPEC plus, or more technically speaking, the 8 OPEC countries that agreed to a big cut back in 2024 have agreed to bring those barrels back to market, right? And so we've had a series of meetings this summer where each time they keep bringing back more and more production. And now, once we get to September, if you believe their numbers, all of the 2.2 million barrels they took off the market will essentially be returned to the market, or that's the plan anyway. Again, we take a little bit of a different view on that here at the oil balance. We view it more as a justification for the overproduction. We view that more as giving room for Saudi to maneuver a little bit more, because if you think about it, Saudi's really the driving force in OPEC. In OPEC qua OPEC, they are the biggest producer. When you start adding in Russia in terms of OPEC plus, then they're more favorably matched in terms of exports between Saudi Arabia and Russia, just generally speaking, especially outside of sanctions and other things going on. But the point I'm getting to is they've given themselves the green light to increase production, and that should lead to an increase in exports. And we are seeing that to an extent, especially in the month of June. We saw a huge increase. So again, this blue line here is just the 8. So that's 5 OPEC countries and 3 non-OPEC countries that have gone into this agreement. So in June, they really spiked up exports month on month. And again, this is looking at versus December 2024, some sort of control, so we can moderate or look at what the changes have been. So 1.3 million barrels per day more exports in June of 2025 versus December 2024, or which would be back here, the start of our comparison here, is a pretty hefty number. And again, that's sort of filtering through from these increases that they've been telegraphing to the market, that they've been having these meetings about. The problem is, if you look at the U.S. numbers, especially for the month of July here, where the net impact, again, versus December 2024 export numbers for both groups, have basically canceled each other out. So what's going on, and how do you interpret what that means? So again, through the lens we're looking at it, and I appreciate that people have other perspectives, and please put those in the comments. But the perspective that I'm coming from, and the lens that I'm looking through, says OPEC plus, or the 8, they have been keeping production relatively high. There is not a whole lot of incremental growth possible, except for Saudi Arabia, which has a lot of potential export capability. And it's more of just trying to play market share games. And I think that's what we saw play out in June, is that the 8 sort of flooded the market with these export barrels. Again, everyone's looking at Asia as being where demand growth is going to happen. So, OPEC, especially those Middle Eastern nations of OPEC, their best customers are Asia. That's what they're pretty much focused on. And Russia, to an extent, too, after the sanctions, after all the stuff that's gone on in the Ukraine, again, their biggest customers are now in Asia. We're looking at China, India, other countries like that, right? So it seems to me what this bottom chart here is telling us is U.S. barrels kind of got squeezed out of the system for the month of July. So if you go back and look just at the U.S. data, exports were down almost 1 million barrels per day year on year in July. So that's huge, right? And we saw the basis markets continuing to grind lower. So the market was definitely reacting to those barrels not being able to leave. And Pad 3 is one of the places where we are seeing inventory maybe start to creep back up a little bit. Again, because we're not sending out so much. Well, why are we not sending out so much? If, maybe an OPEC purist, if you take OPEC completely at their word and share the same outlook they do on demand, you would think that demand is just almost unlimited and going to the moon, and you can return 2.2 million barrels per day to the market in one summer, and nothing bad is going to happen. Well, maybe that's not the case. Maybe demand is limited. Maybe these export numbers in the month of June kind of killed it for everyone else. And US is having a really hard time keeping up with those numbers. So I'm not saying, cry for the US markets because they couldn't export their stuff. That's not what I mean. I think the problem is deeper in that demand is not unlimited. It is, there is a cap on it. Now, who is sort of taking these barrels? And then there's the second argument or the secondary argument saying China's taking a lot of barrels, but perhaps they're not running them all. They're putting barrels into storage because they do have a lot of strategic storage or even commercial storage. They have a lot of space to put barrels, especially when the markets get relatively cheap in the big scheme of things, which they're starting to again. So again, this could get more interesting. But it's pointing to me, going back to what EOG was saying, that maybe we're seeing this shift in sentiment where the market's realizing demand is not unlimited, right? That there is a cap. If OPEC decide to really ramp up exports, that's going to cut people out from other places. And again, that's fine. It's a market share battle, but let's just, meaning there's a limited amount of demand to go around, and one group of countries is going to be able to fill that, and at the detriment of another group of countries. That's all I'm trying to say. But that does lead to a shift in sentiment. Now, what's interesting going on, of course, in real time is this past week, we've seen Trump putting more sanctions on India because they're buying so much Russian oil. And yes, there is a bit of a buying frenzy, or at least the interest is there. A lot of phone calls being made along the Gulf Coast trying to find September barrels for export that would go to India to backfill these barrels that Russia may not be able to sell into India. So it's all a bit complicated from that perspective. And it's also, in a sense, artificially restricting the market in that there is supply out there, but you've just told India, who's a fairly big importer of crude oil, that they can't take imports from their best supplier, from their biggest supplier, right? So you're not, long story short, the barrels are there. You're just telling them they can't have them for right now, and they'll end up going someplace else. And again, maybe that goes to China, and it ends up being in Chinese inventory for a long time. I don't know. We'll see. That's maybe a bit of a different subject. But the point is that we are, it seems like, seeing the sentiment shift. And what does that mean in terms of the market? Well, I think that means as we end the driving season here, we get more and more selling coming in. Maybe we retest that $55 area. Of course, we could get hurricanes. We're going into the bulk of hurricane season, or the meat of hurricane season, however you want to phrase that. So there's still exposure to that. U.S. inventories on a lot of things, as we just saw, is still low. If there was some sort of supply glitch, you probably get an outsized reaction because of that. Because inventories are so low, you don't have the safety, behind you that you would normally have if inventories were sort of on the higher end of the 5-year range. Given the same sort of supply disruption, maybe the market wouldn't react if inventories were super high, but because they're super low, maybe you get this outsized reaction that people wouldn't expect. So I think there's still risks to the bear side of the market, but if we can weather those storms and sort of get through that, I think the market is starting to look pretty heavy, which then goes towards, well, what is EOG talking about then in 2026? So, of course, the powers that be, meaning the International Energy Agency and these other firms that like to project demand going forward, are usually pretty optimistic about global economies and that sort of thing. So from that perspective, yeah, you could see global demand growth in 2026 growing even faster than what we've had in 2025. Again, does that all come from the NGL side of the market, or does that come from transportation fuel, or is there a healthy mix in there? Hopefully, there's a healthy mix in those numbers. But it's really telling that the best independent U.S. oil and gas producer is telling the market and telling their investors, let's just sort of look past this year and look to the greener fields of 2026. So that's all I got for you today. Again, please go to our website, theoilbalance.com. Please sign up for a trial of the bigger chart pack that has a better explanation, more charts and that sort of thing than we could cover here. And please like and subscribe this video, and we'll see you next time. Thank you. Bye.